This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Haidi. Stroud-Watts. The top stories this hour. Asian stocks are set to open under pressure as traders assess corporate earnings, geopolitical risks and Trump's trade war, telling us from sources that the president may now exclude some countries from his April 2nd reciprocal tariff splits.
Australia's Treasurer telling Bloomberg Trump's policies will have a seismic impact on the global economy. We'll hear from Jim Chalmers as he prepares to hand down his budget on Tuesday.
And I'm Stephen Engel within the Diaoyutai State Guest House in Western Beijing at the China Business Forum, Development Forum, where Premier Li Qiang says China is preparing for Trump tariff shocks that exceed expectations. This as visiting U.S. Senator Steve Daines tells Bloomberg exclusively that Beijing must fix the fentanyl flow before any further trade negotiations.
A lot for investors to be watching, from China to the US, of course, as we head into yet more uncertainty when it comes to these potential reciprocal tariffs, right? We're hearing that the president's planning to announce these on April 2nd. Are there exclusions that we should now be considering? Get a bit more on that in just a moment, but take a look at how markets are setting up. We are seeing Asian stock sentiment really under pressure as the rise of uncertainty continues to engulf that sort of risk sentiment. We're seeing Australia just coming online. This is a staggered session, so at the moment we're seeing a little bit of downside there, about a 1/10 of 1%, but we have seen equity futures in Australia, also across Japan and mainland China, pointing to losses at the reopen here on Monday. Dollar yen just holding under that 150 level. We're seeing dollar China one to watch as well, as we see sort of these developments over the picture for tariffs as well. Take a look at how US futures are shaping up at the moment as we continue to see that vulnerability when it comes to sentiment, right? S&P futures are looking pretty optimistic. We're also seeing some upside there when it comes to tech-heavy NASDAQ 100 futures there as well. Brent, it's been a pretty eventful couple of weeks when it comes to energy markets, unchanged at $72, just a bit over, but crude has been edging that little bit higher as these supply concerns, the geopolitical concerns, what's going on in the Middle East, have really outweighed the broader economic outlook and the supply side, which of course remains challenging, Paul.
Well, we're closing in on, what's it called, Liberation Day, April the 2nd, when we hear that big new announcement from the White House on the next round of tariffs. Now, a lot of countries, a lot of sectors are going to be impacted here, although President Trump said, look, any country that doesn't have tariffs with the US, any country that the US has a trade surplus with, will be spared, although that has not saved Australia. So really, it's all up in the air here.
It is, and it's interesting because, you know, you talked about no special treatment for Australia and there was some disappointment. There's also been no special treatment for countries like Japan, you know, some of these classic, traditional, long-standing US allies. So I suppose in that sense, you know, there is, I guess, maybe a sense of more fairness this time in the way that these tariffs are being applied, but certainly these nations are not being singled out. But we are set to expect that some exclusions, as of now, that's a very important kind of caveat, isn't, because we know that policy when it comes to Trump's administration can change very, very quickly. The not planning when it comes to separate sector-specific tariffs to be unveiled at the same event, that doesn't mean, I guess, it won't be announced at separate events. But so much wait and see there. And of course, China, very much an economy that is waiting and seeing too, perhaps keeping some of their fiscal powder still dry to try and react, because Chinese Premier Li Qiang says his country is prepared for shocks that exceed expectations from President Trump's reciprocal tariffs.
We may have unexpected shocks, mainly from external factors. When necessary, the Chinese government will introduce new incremental policies to ensure the smooth operation of the Chinese economy.
Let's bring in our Chief North Asia correspondent, Stephen Engel, who's on the ground in Beijing this morning at the China Development Forum and joins us now. And Steve, what did we hear in terms of, I guess, how Beijing is prepared to navigate this level of uncertainty in that relationship?
Well, I think that's why there are dozens of multinational executives joining the China Development Forum here in the Diaoyutai State Guest House in Western Beijing, as they do every year. This is the 25th annual China Development Forum. They're coming to kind of get a sense of how China will respond to the external shocks, as well as what the marching orders are following the National People's Congress to, essentially fulfill the promise and the pledge by Li Qiang at the NPC economy is to prioritize domestic consumption in the face of these potential escalating external shocks. And that's what they heard from Li Chang. You just heard from him there, essentially saying those external shocks could exceed expectations. So they're preparing that with boosting domestic consumption. He says countries should open their markets in the face of growing economic fragmentation. That is news that many of the executives gathered in the building behind me, Villa 14 in the Diaoyutai State Guest House, were welcome to hear, because again, that has been a long-standing complaint of big corporations wanting to do business in China, and that's market access. So if China is sort of covertly saying open markets are the way to beat economic fragmentation globally, that is good news. So Tim Cook of Apple was here, Pfizer's Albert Bourla, of course Blackstone's Steve Schwartzman, always a regular participant here. We had others, including many from Europe, as they see a way to navigate the friction that's coming from the White House, as well as their relations with China have been fragmented, no doubt, by tariffs of their own on EVs and other products. So lots to discuss here on day 2, the final day before we head off to the Boao Forum in Hainan Island later today for the next 4 days of gatherings between Chinese officials and multinational executives.
Well, also there in Beijing is US Senator Steve Daines to talk trade with China, and of course linked to the trade story is the fentanyl story. What's the US saying? It's been quite explicit really in what it expects from Beijing in this regard.
Yeah, this is usually a business discussion here at the China Development Forum, but it took obviously some geopolitical overtones with Steve Daines, the Republican senator from Montana, who is sort of the unofficial envoy from President Trump to convey some messages, and have, as he did yesterday, along with 7 executives from top American companies, had a meeting in the Great Hall of the People with Premier Li Chang. I also talked briefly with Steve Daines in the hallway behind me, in the villa behind me, and then later last night we got an exclusive interview with my colleague on Bloomberg News, Lucille Liu, and I interviewed him, Steve Daines, for about 10 minutes as he was boarding a flight back to what I suspect to be Washington, D.C., and he said, look, the issue of fentanyl is front and center. Here's what he had to say.
It'll be difficult to have any conversation about tariffs and non-tariff barriers until the fentanyl precursor issue is resolved. President Trump's position was heard loud and clear, and the Chinese received that, they understood it, and we're hopeful that we'll see decisive actions taken to stop the flow of these precursors.
The other big unknown is whether Xi and Trump will have a meeting. No clear guidance from Senator Daines on that front, other than to say it will likely happen within this year. That's a long time frame for such contentious issues to be resolved.
All right, Chief North Asia Correspondent Stephen Engel there in Beijing. All right, for more on markets, let's bring in Bloomberg M Live strategist Marc Cranfield. Marc, this week I think we're going to be talking a lot about Liberation Day on April the 2nd. How are markets positioning ahead of this announcement?
Well, we're starting off pretty well here. Slightly optimistic view of the markets. Look at equity futures, S&P 500 and NASDAQ have both got off to a good start this week. That report that Trump's tariffs are going to be more targeted, more specific, and not including every country in the world, that's been given a bit of a relief rally first thing this morning here in Asia. People are optimistic that that is how it's going to play out next week. Of course, equity traders tend to see the good news more than the bad news, so maybe we shouldn't be too surprised about that. And also, there's a long way to go, as you were saying earlier. Just because we have one report saying that Trump is going to be more nuanced about it doesn't mean to say by the time it hits next week that will still be the case. But at least for now anyway, traders are taking the view that if it's going to be a targeted approach, that's much better, and that there is reasons here to be slightly optimistic. Of course, the flip side of that is that you're seeing the Treasury futures trend lower. People don't need to be so concerned about having havens. We're also seeing the yen trade weaker as well, because if we're going to have a situation where the whole trade war is dialing down, if it's going to be a more modest approach and other countries don't need to respond as aggressively, that means there'll be less need for investors to go for the haven plays such as treasuries and yen, and you're seeing that a little bit so far this morning. So certainly the mood at the moment is a bit better, but there's a very long way to go, and traders are used to whiplash. They've seen before that just because one thing is said, it can be reversed quite quickly, so they'll be monitoring the headlines very much over the next 24, 48 hours. This week is pretty light on US data, so it's really all going to be about the headlines that come out of Washington and how traders respond to that.
Are we expecting much focus when it comes to, as you say, some of the data points, particularly as this last mile of inflation seems more complicated now with the bringing forward of these tariffs?
Well, if you look at what the Federal Reserve had to say last week, they seem pretty relaxed about it, which is something that the bond vigilantes will be looking at very closely. We've heard from the Federal Reserve they're not willing to make any prejudgments on how inflation impacts the data in the months ahead, just because there are some new tariffs, there could be more. The Federal Reserve is taking a wait-and-see approach. They seem quite relaxed about it. Now, at the same time, they've said in their dot plots that they still see 2 more interest rate cuts. Now, the bond vigilantes will be looking very much at the long end of the curve here. If the Fed is going to hold back, and yet there are signs of inflation coming through, inflation expectations are the highest they've been for several years among consumers. So you've got a bit of a disconnect here. And the bond market will be the way that tells you how this plays out. The curve is steepening slightly already. There could well be more to come in that respect. Long-term investors already short of the US treasuries in the 10-year sector, they could extend that as well, because they certainly are going to have no patience whatsoever if they see signs that inflation data is ticking up when the Fed still wants to take a more modest approach to things. Those two don't make sense. So the Federal Reserve, the speakers that we hear over the next couple of weeks, they'll have to measure their words very carefully here, because if the equity market is more optimistic, the bond market will not be.
All right, Bloomberg's Marc Cranfield there. Let's get you across an alert on the Bloomberg at the moment. James Hardie depository receipts here in Australia moving quite appreciably to the downside, off by about 10%, a little bit more now. This is on the news that James Hardie Industries, this is a building products firm, has agreed to buy Chicago-based ASIC company. $8.75 billion cash and stock deal. That deal values ASIC shares at $56.88 each. That's a 37% premium to Friday's closing price in the US. ASIC makes pergolas, home decking as well. So James Hardie is saying that this is going to accelerate our growth strategy. Shares currently softer by more than 10%, Heidi.
Yeah, not quite convinced so far, but we'll keep watching that one throughout the course of the session here in Australia. But in the meantime, the Milken Institute set to hold its second Global Investors Symposium in Hong Kong beginning today. Bloomberg's Avril Hong is there. Avril.
Yeah, Heidi, here at the Milken event in Hong Kong, and top of mind, the global uncertainties. How are investors positioning in the here and now for long-term returns? How have attitudes shifted towards China, and how are investors looking to position in order to capitalize on the AI momentum? Plus, amid the increasing convergence with public markets, what are the opportunities in private markets? Those conversations coming right up. Stay tuned for all that. This is Bloomberg.
Australia's Treasurer is warning that the Trump administration's policies will have a seismic impact on the global economy. Jim Chalmers spoke with Bloomberg ahead of delivering his pre-election budget on Tuesday about the risks that Australia is facing.
Now, this is a whole new world of uncertainty that we're dealing with here. The changes out of the US, for example, are not surprising, but they are seismic. We're seeing uncertainty, policy uncertainty out of the US. China is slowing. We've spoken about that on a number of occasions. We've got conflicts in the Middle East and Europe. We've got political uncertainty and division around the world. And so the budget is designed not just to respond to all of that uncertainty, but to make ourselves more resilient in the face of those external shocks. And the future made in Australia is really the most important way that we're going about that. And there's billions of dollars in new investments in green metals as part of that effort.
Unannounced ones or just the ones you've announced? So
the ones that we've made clear already, they'll be budgeted for on Tuesday night. I mean, we've got a huge agenda that brings together our industrial possibilities, the energy transformation, the strengths and advantages that we have in critical minerals and in other areas. And so we intend to play that winning hand. The world is changing all around us. The world is fragmenting. Supply chains are being reconsidered and rebuilt. And we think we've got a very compelling offer to the world. And so the budget is about making the most of that opportunity, maximising our advantages in the interests of Middle Australia.
Now, on that, I mean, about a week after you hand down this budget, in fact, almost exactly, we're going to see new tariffs unveiled by the US administration on April 2nd. Are you worried that those tariffs could throw all your hard work in the budget completely off track if they are particularly, big or impressive?
Well, obviously, we're concerned about these escalating trade tensions around the world. As I said before, they are casting a shadow, not just over the budget, but over the global economy more broadly. Australia's got a very trade-exposed economy, and we are concerned about these trade tensions. Nobody wins from a trade war, least of all a country like ours. And so we're obviously engaged with the US administration, with our counterparts there, but we're also designing a budget which is all about making sure that we are beneficiaries, not victims of the way that the world is changing. Future Made in Australia is part of that. The Buy Australia plan is part of that as well. All of this is about recognising the way the world's changing and trying to make sure not that just we're not victims of that change, but that we can benefit from those change as countries around the world are looking for reliable partners like us.
Now, you've mentioned the sort of negative side from the US, but there's a potential positive side in that the new tariffs put on China might unleash a wave of economic stimulus from Beijing. I mean, obviously, there's a few unknowns at this point, but in your opinion, in the Treasury modelling, do you think that will end up being a net negative or a net positive to Australia when balancing those two factors?
Well, we've seen a number of steps taken by the administration in Beijing to try and support growth in the economy, but we're still seeing China slowing.
Australian Treasurer Jim Chalmers speaking to Bloomberg's Ben Westcott in Canberra there. We have more ahead on the Asia trade. This is Bloomberg. Ukrainian President Volodymyr Zelensky says talks with US officials that began on Sunday in Saudi Arabia were constructive and useful. American and Russian delegates are expected to hold separate talks on Monday as the White House pushes for a truce in the Ukraine war by April 20. Bloomberg's Michael Heath joins us now. So, Michael, an April 20 deadline, considering the history of this conflict so far, how realistic is that?
It's very ambitious, Paul. I mean, it's interesting because this year the Orthodox Christmas, which obviously is celebrated in Russia, and the Western Christmas come at the same time, so April 20. So it's a symbolic and it's a nice deadline, but just the way that, exactly as you described, the way we've seen things unfold, Ukraine has been pretty willing so far to go along with the US, Russia much less so. And even the talks today, we had the talks in Riyadh with the Ukrainian and US officials. We don't have many details on that, but it seems to be about how to sort of apply this ceasefire on energy infrastructure, or the not firing on each other's energy infrastructure, and then trying to extend that to the Black Sea. But Russia's delegation it's pretty low level that's going there. They're not decision makers. Obviously, President Putin is the main one, but even among his entourage, they're fairly low level. So I'm not sure what what the expectation is. I mean, Russia is still attacking Ukraine reasonably heavily. Ukraine is retaliating, so it's not like we're seeing a lowering of tensions here. And while President Trump did put pressure on Ukraine, obviously, as we saw after the White House, he's doing very little on that front in Russia, even as Russia drags its feet. And there's very little expectation that he's going to actually ratchet up sanctions or anything like that on Russia.
We are expecting those separate Russia-US talks on Monday, but as you say, the demands from Russia's side have been pretty hefty. I think Lithuania said Russia is, this is an imitation of negotiations rather than a seriousness to...
Yeah, well, look, I mean, you get that strong feeling because they just don't... there's no sense that that President Trump is going to put any pressure on them. And Russia just completely bucked this whole idea of a 30-day truce. And it has sustained its attacks, even if it's perhaps not hitting energy infrastructure, it's hitting everywhere else. And civilians have been killed even on Sunday. So, yeah, and then we saw, there was an interview with the US main negotiator, Steve Witkoff, and he was coming up with Russian talking points in many respects about these 3 or 4 regions in eastern and southeastern Ukraine, that these are Russian-speaking regions, which they are, and that they're very keen to become part of Russia, as referendums there showed. Now, no one takes those referendums seriously. They were held in a wartime environment, and from the bibs and bobs that we see of people who are in those regions, they didn't expect it to become a war zone and have a really authoritarian sort of regime in there. So it's really debatable whether they actually do want to be part of Russia. But yeah, to cite those referendums, it's quite astonishing really to see.
And we've got to talk also about the other conflict that's going on in the Middle East, in Gaza. The ceasefires, of course, fallen apart. It's had a fairly profound effect on Hamas leadership.
Yeah, I mean, the sort of de facto cabinet that Hamas has in place, it's more governing. It's the de facto cabinet they had, they've lost 11 of 20 members in strikes just in this latest action. So, yeah, who would take decisions on part of Hamas if we ever do get back to talks would be a pretty interesting question there as well.
Bloomberg editor Michael Heath there with the latest. Let's take a look at some of the other global headlines that we're following this hour. And Turkey has formally arrested Istanbul's mayor, Ekrem İmamoğlu, on corruption charges. The move to jail İmamoğlu could prevent President Erdogan's main political rival from running against him in the next elections. The arrest has already triggered mass protests across several cities. Turkey's capital market regulator has banned short selling and relaxed share buyback rules to cushion the potential market turmoil. Canadian Prime Minister Marc has called an election for April 28th after requesting the dissolution of Parliament. Polls indicate the race will be a close contest between Carney's Liberal Party and the Conservatives, led by Pierre Poilievre. Both parties have promised tax cuts and are making the case at who would be better at negotiation with President Trump over tariffs.
President Trump claims that Canada isn't a real country. He wants to break us so America can own us. We will not let that happen. We're over the shock of the betrayal, but we should never forget the lessons.
Pope Francis has made his first public appearance since hospital treatment for double pneumonia. Sitting in a wheelchair, the 88-year-old thanked and gave blessings to well-wishers gathered outside Gemelli Hospital in Rome. Pope Francis has returned to his residence at the Vatican, where he'll convalesce for the next 2 months.
Right, let's take a look at how we're tracking here in Australia. We've been up and running now for about 26 minutes. We're seeing a little bit of softness on the local market. It was a pretty good week last week for the ASX, up 1.8% for the week, but a bit of weakness there creeping in at the moment. One stock we are watching is James Hardie. Well, these are depository receipts at least. This is an Australian building products company now based out of Dublin, but that stock off by more than 10%. On news that it's going to be buying ASIC Corporation or company. This is a Chicago-based maker of decking and pergolas. That deal values ASIC at a 37% premium on Friday's close. So James Hardie depository receipts are slipping there. Not a great deal of change for the currency ahead of the budget that's being handed down on Tuesday, of course, and we do anticipate an election announcement in Australia shortly after that. Let's take a look at how US futures are tracking as well. It was a kind of flat end to the week on US markets. Futures currently poised a little bit towards the upside. And we've got Nasdaq futures there better by about 0.5%. Crude prices sort of flat at the moment. Got a lot of China energy companies reporting this week, including CNOOC and PetroChina. We have more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia Trade. Well, the Milken Institute is holding its second Global Investors Symposium in Hong Kong, bringing together business leaders for discussions on navigating market uncertainty. Let's get over to the event where Bloomberg's Avril Hong is standing by with our next guest. And Avril, well, those uncertainties are certainly plentiful.
Absolutely. Top of mind for investors, these uncertainties clouding the global economic outlook. And it's a time where the faith in U.S. exceptionalism is also being tested. So what sort of opportunities and challenges does this present for China and other Asian nations? Joining me now is Robin Hu, Milken Asia Chair, as well as Temasek Advisors Senior Director. Great to have you with us bright and early, Robin.
Well, good morning.
What are you hearing on the ground in terms of the attitude shifts to China?
I think the attitude is turning. I see, in a sense, a measured optimism. As we all know, that the biggest challenge for China is actually transforming its economy from an export-dependent and real estate-dependent economy to one that is driven by innovation and domestic consumption. Now, if China is capable of making that transition well and succeed, then I think we can look forward to a period of exciting growth again. And if it doesn't, then I think China will be headed to some more troubles.
Yeah, but they've been trying to orchestrate this more consumption-focused economy for a long time now. What makes you think that now is the time, or this is the year?
Well, I think the problem of China has been quite complicated and very compounded as well, and therefore it takes time to actually resolve them. But the series of the stimulus program starting last year, I think, are beginning to take effect. And as we all know, at the end of the day, it boils down to confidence, and confidence of the people, confidence of the corporate world, confidence of the capital market as well. And we're seeing the emergence of a very exciting suite of Chinese innovations coming out of nowhere. You would know that DeepSeek, the open source big data model in artificial intelligence. We know Naja too, the animated Chinese movie that took the world by storm. And before that, Black Myth Wukong. I don't know if you're a gamer, but if you're a gamer, you might have played it. So all these things came out of nowhere, and I think the implication of all that innovation has been the impact on confidence and the confidence of the market as well. And we noticed that the year-to-date growth of the Hang Seng Index for this year is 23%, and long may that continue.
But it also begs the question whether stimulus as the final piece of the puzzle is playing ball. And for that, you kind of need the local governments to do their part. To what extent can they, given their debt burdens?
Well, I think the problem and challenge to China has been more than the debt burden as well. I think for 5 years, China has been very depressed economically, a combination of cyclical, systemic, geopolitical, and indeed self-inflicted problems all came together. So I think it's now into the third year after the recovery of the COVID. We're beginning to see some green shoots developing in the marketplace as well. The industrial output as well as retail consumption. The data that has been just released are both exceeded analysts' expectations. So I think we can draw some optimism from that.
Okay, there's also been a sort of reassessment in the U.S. position in global leadership. Do you see this as an opportunity for China?
Well, it is an opportunity for everyone, an opportunity for the U.S. as well. I think we have to realize that the dividend yielding period of globalization is now behind us, and we have now entered into a world of strategic decoupling, which is the precursor to reshoring and reshoring and onshoring of U.S. industrialization. Now, as we all know, superpower cannot be superpower unless you are a military power, and you cannot be a military power unless you are an industrial power. So that's the logic behind it. So hence, I think we need to see the strategic decoupling as a strategic necessity rather than anything else. And strategic decoupling is not all bad, because what it means is that there will have to be investments in R&D, investment in additional supply chain and capacity building as well, and therefore it will provide many opportunities for businessmen with far-sighted view to take advantage and capture value.
What about challenges, particularly for EM in Asia, in Southeast Asia? You know, should they be preparing, or are they already seeing some parts of a China shock 2.0, 3.0?
Well, I think it is both a challenge and opportunity for countries like in the Southeast Asia. Because the good thing about those of us living in Southeast Asia is that we know that, number one, we are very accustomed to living in an asymmetric relationship with giant powers around us. For 1,000 years, we live with neighbors like China and India. That's part of our karma, if you like.
But
so
this time around, those reciprocal tariffs could hit a broad swathe of these Southeast Asian economies, and it's quite different from, say, trade war 1.0. So in this environment, do you think Southeast Asia can still benefit?
I think we'll have to, right? Because that's going to be the new constant when the reciprocal tariffs plan comes into effect. In fact, on 2nd of April, it's hardly a week away from now. Its details we do not know, and its implication also we will not know. Will that be a broad sweep of all tariffs that will be applicable to all nations across the world? I don't think so. I think reciprocal means that it's bespoke, that is perhaps just a design that is a specific package with each and every nation on this earth that does trading with USA, which is essentially everyone. So I think from that point of view, you might see it as a tsunami, but in terms of how each and every relationship that may be defined as reciprocal, which will not be the same across all countries, provides space, I think, for right-sizing and negotiation. Those with agencies and those with the chips on the table, I think we'll have a better stake outcome.
So a potential tariff tsunami, where are investors positioning? Where's the shelter from the oncoming storm?
I think that's very well summarized.
So where exactly do you think investors are looking at positioning? Actually, it looks like Southeast Asia could benefit from all this. Robin, really good to chat with you. Thanks so much for coming and sharing your insights, and all the best for the rest of the event today. Robin Hu, Milken Asia Chair. Paul?
All right, thanks, Avril. That's Bloomberg's Avril Hong at the Milken Institute Global Investors Symposium there in Hong Kong. And we've got much more coming up from the Milken Institute. We're going to be speaking to the Philadelphia Municipal Retirement System CEO in the next hour. Also conversations after that with Gore Capital, Wellington Management and PIMCO as well. Now, Stephen Orland's president of the National Committee on US-China Relations thinks that China's economy is recovering despite tariff threats. Speaking to Bloomberg on the sidelines of the China Development Forum in Beijing, Orland's added that Chinese tech companies like DeepSeek have been forced to innovate due to restrictions imposed by the US.
You see green shoots, and I think the stock market actually recognizes the green shoots. So that's why we've seen the Hong Kong market, the Shenzhen market, the Shanghai market way outperform the US market, because there's a recognition in the market that things may be improving. Now, we've seen kind of false starts before, but this one, based on this speech, based upon meetings I've had with the Chinese government, looks like it's more real.
Do you think there's an understanding in the Trump administration that this is actually the trade action from abroad is maybe spurring an acceleration of this reflation in China, especially when it comes to advanced technology, as exemplified by DeepSeek and others?
No question that, and it was the Biden administration and now the Trump administration, that kind of the restrictions on exports. So why do we see DeepSeek? Why do we see AI companies in China growing as rapidly as they are? Because they've been forced to innovate because of the policy, the restrictive policies. So we're seeing that. the Chinese are preparing, so April 2nd, we're going to see tariffs. I think the consensus here among think tanks, among academics, among the Chinese government is that those tariffs are going to hit. So some of this is preparation for those tariffs. Increased central government spending will be, to some degree, an insulation against the tariffs, which is going to slow China's economy.
Li Chong said today that they're preparing for even bigger shock, external shocks than most expect. What level of tolerance do you think the Chinese leadership has? 20% tariffs, it seems as though they can absorb that to a certain degree, pass it on to consumers elsewhere, improve efficiencies in their factories, boost consumption and the percentage of domestic spending. But how far is too far?
Well, we don't know is the answer. You know, I'm constantly talking with economists saying, so 20, 30, 40, when does it reach a tipping point? The answer is all these tariffs slow China's GDP and requires the central government to spend more. They have decent amount of what I would call fiscal powder to kind of spread in the economy and have it respond to U.S. tariffs, respond to a slowdown in the export sector in China. They have, over the years, reduced their dependence on the U.S. market. You know, so we've seen this gradual decrease already, and my expectation is they are prepared. They're hoping this doesn't happen. They're hoping they can strike a deal with Trump. They're hoping they can take more exports of American agricultural goods, energy, airplanes, machinery, and that will satisfy President Trump. I believe it won't.
How likely is some sort of concession from Trump, who wants and always talks about his relationship with Xi, but also talks about China being the biggest threat?
We will need a meeting between President Trump and President Xi to tell each bureaucracy that they need to adopt constructive policies. If there is no meeting, the inertia favors increased tariffs, increased export restrictions, increased investment restriction, all of these issues which will make U.S.-China relations more difficult and will ultimately hurt the Chinese people and the American people.
Stephen Orland's their National Committee on US-China Relations President, speaking it to Bloomberg, Stephen Angle there. Just ahead on the Asia trade, a controversy over shopping voucher handouts to lawmakers see support for Prime Minister Ishiba's government tumble to a record low. We get some analysis next. This is Bloomberg. Japan and China just held their first economic dialogue in 6 years amid trade pressure from the US. Although China is Japan's largest trading partner, the two nations have been at loggerheads over issues banning a ban on Japanese seafood. Bloomberg East Asia Government Editor John Herstovitz joins us now. So, John, I am curious, have the dynamics between Beijing and Tokyo changed since Trump returned to the White House?
We're seeing the nations, Japan, China, and also South Korea, trying to recalibrate where they're going to be. They're all staring down this April 2nd tariff threat from Trump, and all of these countries are heavily dependent on trade with the U.S. For Japan and South Korea, their biggest trading partner is China. Now, if you take a look just at the GDPs of Japan, China, and South Korea, it's on par, just a little bit less than that of the U.S. And this comes like a year ago. We had Japan and South Korea, the ties were very strong. Then Prime Minister Kishida was going to head to a summit in April where he was going to work with the Biden administration to pressure China on things like exports of semiconductors, which could be used to help China's AI industry. Now it's a much more tenuous situation. We have the leader of South Korea, Yoon Suk-yeol, the president, facing a decision on impeachment. We have the new Prime Minister, Ishiba, with his support rate tumbling. And they're coming together and trying to figure out what to do next.
So what can we read into these low poll numbers for the Japanese Prime Minister, Ishiba?
Yeah, it doesn't look very good. Ishiba came into power with the idea of cleaning up the policy, the problems with the ruling Liberal Democratic Party politics and money. He tried to do a clean image, and this gift of shopping vouchers for lawmakers just has not sat well with the public. So Ishiba is in a government for the first time that his LDP and the ruling partner Komeito don't have a majority in parliament. So he's heavily dependent on the smaller parties for policy. And there's also the prospect of an upper house election in July. The LDP has to make a decision whether they want to go with Ishiba for the election. In parliament, the budget is passed, but in order to get things done, the opposition parties are really able to confront Ishiba to get their points ahead. So he's in a weakened position. The poll numbers just are bad for him, and it's a period of flux for what will happen next with the LDP and the current Prime Minister.
All right, Bloomberg East Asia Government Editor John Herskovits there. Well, joining us now is Amy Catalinac, Associate Professor of Politics at New York University. Amy, John was just outlining there the challenges facing Shigeru Ishiba. In your view, how long can he last as Prime Minister?
So I think he can actually last. He can hang on for a bit. His poll numbers are bad, but the prior Prime Minister, Kishida, he had poll numbers that were equally bad for a very long time. About 9 months in 2024, Kishida's poll numbers were in the 20s. He did eventually resign from the position. But I think Ishiba may be able to hang on, actually. He's been doing negotiations with the opposition parties. So I think that even though he's the leader of a minority government and he's vulnerable to a non-confidence motion supported sort of by the opposition, he's been negotiating with them. That has, I think, reduced some of their desire for a non-confidence motion. Right now, he has to worry about upper house members and his party. They face, as John said, an election coming up in July. But I think that it's very uncertain. Like, I think the prospect of a non-confidence motion and him, he could call an election at that point. Elections bring uncertainty. I think he actually may be able to hang on for a bit.
Is part of the reason here as well that political instability at this time, when you consider what's happening, particularly with the trade environment, could be seen to be less than ideal for Japan?
Yes, for sure. That instability, and like Japan would really benefit now from a very strong leader. But I don't see a strong contender waiting in the wings. When Ishiba was elected as LDP president in September last year, there was a sort of second-placed person who many people saw as potential. She got second. She was very close actually to becoming Japan's first female prime minister. Her name was Takaichi Sanae. But in the election, members of the faction formerly associated with Prime Minister Abe, who gave her a lot of backing, they were significantly weakened in the election. Many of them lost their seats due to the money politics scandal. That was also the reason why the prior Prime Minister had such low approval ratings. And so I don't really see, so her position is weakened in the party due to the scandal, due to the money politics issues. So I don't really see a strong contender waiting in the wings. So it's not obvious to me, I think, even for LDP politicians, they want members of the ruling party, they want a strong leader, but it's not obvious to me that there's someone else that they know that they could do better under. Hence, maybe they're going to just hang on with Ishiba for now.
So basically you're saying that even if these LDP MPs are dissatisfied, there aren't better alternatives at this point?
Yes. Yeah, and there's also just a lot of uncertainty.
No, continue.
So they could they could align with the opposition to get a non-confidence motion submitted to the Diet. But if it passes, which is what you can do in a parliamentary system, but if a non-confidence motion passes, Ishiba, he could resign and his cabinet, but he could also dissolve the House and take it to the voters and call for an election. And that could lead to that could put the LDP in an even weaker position. So many LDP members may be dissatisfied with him, but they don't know for sure that they're going to be better. If there was an election tomorrow, the party may lose more seats, they themselves may lose a seat. So it's the path to actually getting rid of him and replacing him. The path is very uncertain. And I don't think it's sort of obvious that that the dissatisfaction with him, they would calculate that this uncertain path is one that they should take.
There's an argument that his, squeaky clean public image was really one of his greatest assets going into this top job, right? How badly does his reputation get tarnished by, what ultimately relatively seems like a fairly small size scandal?
Yeah, it is. I shouldn't say it is. Anything that's against the law is obviously it's against the law. But in general, giving 15 members of his party, first-time MPs, about $680 worth of gift vouchers and inviting them to a party, then that doesn't really, in the grand scheme of things, maybe lead to the resignation of a Prime Minister. But the problem is that the party has been mired in a money politics scandal since the end of 2023. And it just dominated news coverage in Japan last year, and it eventually cost Ishiba's predecessor, Prime Minister Kishida, his job. He eventually stepped down in August, ostensibly to take responsibility for the scandal. But what the scandal was about was that there were just opaque money flows within the party. So factions were holding parties, they were getting a lot of money from businesses, they were not declaring that money as they were required to do so under political campaign finance laws, and then they were also funneling some of that money back to individual LDP politicians. Those politicians were also not declaring it properly. And this was all uncovered by the media. And Prime Minister Kishida tried many things. 2024 domestically in Japan was all about him trying to levy punishments on these people. And eventually he just wasn't. He passed some campaign finance reform, but it wasn't enough. It wasn't what the opposition wanted. That was why he had very low support rates. And so it's this particular incident recently with these gift cards, as you said, Ishiba came in with kind of a squeaky clean issue. So the reason why people are upset is because this is sort of suggesting that no one in the party is immune to this. And this is really a large-scale problem with the LDP not following the correct laws and not being transparent about where the money is coming from and where it's going and what it's being used for. And that's why this particular incident has led to such a decline in his support.
Amy, really great to have you with us. Amy Catalinac, who's the Associate Professor at New York University. Subscribers can watch us live and see our past interviews on our interactive TV function. That's at TV Go. You can dive into any of the securities or the Bloomberg functions that we talk about and join the conversation. You can send us instant messages. Do check it out. That's at TV Go. Welcome back. Some of the top corporate headlines that we're tracking this hour, and Tencent has unveiled an upgraded reasoning model as it tries to compete for leadership in China's increasingly crowded AI field. The company has rolled out the latest iteration of the Hunyuan T1, which operates in a similar way to DeepSeek's R1 with logic and writing capabilities. Tencent has joined Chinese peers, including Alibaba and Baidu, in piggybacking on DeepSeek's success to win new users. Sinopec has reported a 16% drop in full-year profit amid sluggish demand. The slump reflects the company's operational challenges, with nationwide oil usage falling last year as the government pushes refiners to produce less fuel and more petrochemicals. Well, coming up on the next hour of the Asia Trade, the global head of Goldman Sachs' $3 trillion asset and wealth management unit will be with us shortly. We do have the market opens in Seoul and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and to tariff or not to tariff, or to exclude or not to exclude. Of course, this is sort of back to being top of mind for these markets, right? Not to mention we're entering into really one of the busiest earnings weeks of the season as well for Asia.
Absolutely. We're going to be hearing from some China tech names, some big China energy players as well, and all the while counting down to that April 2 Liberation Day, they're calling it in the US.
Yeah, and this time, of course, we've not seen sort of any sector-specific or really geography-specific or, ally-specific exemptions, if you will, the likes of Australia and, of course, South Korea, Japan, all very much fair game when it comes to President Trump. But take a look at how we're setting up, and it is pretty much that risk aversion that we're seeing at the open this Monday morning. We're seeing Australia already online for a little bit, and that's not giving too much of a lead, but the Nikkei 225 off by just about 0.25%. So we are seeing that cautious beginning to the week on, as Paul said, the back of those geopolitical risks, uncertainty over the next round of tariffs, also getting some more sort of inflation-related data from the US as well. This kind of final mile of inflation proves to be quite tricky, particularly in light of the really unknown impacts of these Trump tariffs, right? The topic's up by about 0.1% at the moment. We're seeing the Nikkei 225 just coming online with a little bit of optimism. Dollar yen getting a little bit more sort of that leg up when it comes to just sitting under that 150 level at the moment, and watching JGBs given some of the big moves that we've seen in treasuries lately. Flip it out to Korea, because it is a critical session today, particularly when it comes to the domestic political implications. We're expecting that constitutional court ruling to come through on the Prime Minister Han's impeachment case. That should get to us. The court, I believe, convenes in just about an hour. We're being told that it could be a fairly quick turnaround for that ruling to be handed down. So they'll decide whether Prime Minister Han Duck-soo will be ousted after, of course, the impeachment following President Yoon's martial law decree. So we'll be waiting for that and the implications when it comes to what it means for Korea's leadership and, of course, the broader economy, which has been impacted quite negatively, Paul.
Well, let's take a look at how we're trading here in Australia. Been going for about an hour now. We're seeing a little bit of modest downside here. It would be a lot worse, however, if it weren't for the financial sector. That's currently one of the few sectors in the green at the moment, and makes up about a third of the ASX by weight, really helping prop up everything else right now. The materials sector down by about 1%. Also down, as we've been discussing, depository receipts for the building firm James Haidi. This is following the news that it will be buying ASIC, the Chicago-based pergola and decking company, for $8.75 billion. So that stock off more than 10% at the moment. Take a look at what's happening in the yield space, ticking modestly higher at the moment. Don't fight Besant's Treasury is the new mantra for the bond market. Apparently, Scott Bessant wants yields lower, and he's showing signs of taking action to achieve that, limiting the size of the 10-year debt auctions, loosening bank regulations as well, Heidi.
Let's bring in our next guest, who's Marc Nachmann, who's a global head of Goldman Sachs' Asset and Wealth Management Division, joining us here in Sydney, fresh off a flight just a couple of hours ago. So we're really happy to have you here with us in person. Every day it's sort of, variations on a theme of global volatility and uncertainty and trade. How's that kind of broader macro environment benefiting or affecting your business?
Sure. I think it's interesting. It's a really interesting time right now, given the uncertainty that you mentioned. And I think what we're really focusing on, number one, having a lot of dialogue with our clients, both on the institutional side and on the wealth side, and really having a long-term perspective in terms of how people should think about asset allocation, what geographies, what products. And so I think that's kind of been the focus of the work that we're doing with our clients, and kind of staying away from the daily volatility and taking a longer perspective around all these themes.
Is there more of an opportunity for geographic diversification? I mean, you're here in Australia. I believe you're off to Singapore as well on this trip.
Sure. I mean, look, we continue to be excited about all the regions. There's opportunities in all of them. We continue to build up our business in Australia, for example. There's a lot of interesting opportunities for us to invest in Australia. And there's interesting opportunities for us to help Australian companies invest abroad. At the same time, a lot of Australian investors are looking at the global landscape and becoming broader and diversify themselves. So there's lots of opportunities for us to work with clients here across the global scale.
course, we've seen a lot of volatility in the past few weeks on public markets, but you work a lot in the private space as well. Can you talk to us about some of the opportunities that you're looking into there?
Sure. Yeah, we continue to think that the private markets are really attractive, and I think we've seen kind of that shift in terms of number of companies staying private, number of companies staying private longer, in terms of some of the unicorns on the tech side. And so we think that the private space continues to be very interesting. I think global investors, as both on the institutional and on the high net worth side, are continuing to increase their allocation of their capital into the private space. And so we see interesting opportunities there on both the private credit side, the private equity side, the secondary side. And we think these, the flows into private assets will continue. At the same time, we also see that the boundaries between the public and private markets will continue to kind of become softer, and we'll see more of a continuum between the two markets.
Is the enthusiasm for private markets related to some extent to the way that they're insulated for some of the global upheaval that we're seeing at the moment?
I'd say that at the core, and this is why I mentioned earlier, the kind of long-term investing focus. When you look at long-term returns, on a long-term basis, private equity has outperformed the public equity markets. I think you look at a longer-term basis, private credit has outperformed public credit. And so those are really the trends that large global investors are looking at, and why they're allocating more into private assets.
There's a lot more regulatory scrutiny when it comes to private markets now. Is that something that you can predict what that regulatory response is going to be, particularly with some of the probes that are happening in Australia?
Sure. Look, I think we operate globally. We operate globally under various different regulatory regimes. I think private markets still a relatively new thing, and so the regulators in all the jurisdictions are trying to get their arms around how to get involved in them, and we work very closely with the regulators around that, and we continue to want to make sure that these markets function properly. So I think that this is something we're going to spend a bunch of time on in all the jurisdictions to continue to work with our regulators on.
Where are you trying to grow the business most? Across the world, where are you sort of investing the most, hiring the most?
Yeah, I'd say we have one of the great things about our asset and wealth management business is we have a multitude of growth opportunities. So we're growing our wealth business globally, including in Australia, and we've been growing materially in Australia over the last couple of years. We're growing our asset management business. We're both public and private side. I'd say on the alternative side, private credit, secondary are the two areas that have been the fastest grower over the last couple of years. But we think private equity, growth equity will continue to grow. And on the public side, it's really our solutions type businesses. I think one of the things we continue to see as an interesting trend is people outsourcing the management of their pension funds to larger asset managers. And so we've been doing this with pensions as big as $50 billion, where a pension fund realizes that a large asset manager has a lot of economies of scale, a lot of risk management tools, a lot of sophistications around a lot of these products. So we continue to see the big growth opportunity there as well.
That's got to be a massive opportunity in Australia, given the pension pile here, right?
Yeah, I think we see it's interesting. We see that opportunity across the globe, and I think typically what happens is moments of uncertainty end up creating more opportunities, because the trustees of the pension funds who really want to safekeep the long-term pension for the pensioners really are looking at who is going to be able to provide the best risk management, best return over long term for their pensioners. And so we see that as a big opportunity here. We see it in Europe, in the US, in Japan.
Are there any specific sectors or themes that your clients are talking about at the moment? And just for an example, we've seen a huge run-up and a lot of excitement around AI, but there are now some discussions about whether or not we're seeing shades of .com here.
Yeah.
Could you talk to us a little bit about that?
Yeah, I'd say, when you think about over the last kind of 12 to 18 months, you talk a lot about private credit. That's an asset class that kind of is new in a sense, and I think has some very attractive characteristics. And I think it took people a while to figure out where in their asset allocation to put private credit. So on the one hand, it's kind of a fixed income instrument. On the other hand, it's private, and so people had to figure that out. So the, private credit from a product perspective was very interesting. From a theme perspective, obviously AI, overall infrastructure as a theme is a big theme. When you think about digitalization, decarbonization, all these kind of trends will continue to drive more infrastructure needs. So we see a lot of interest in those needs. I think as with all themes, those are going to go a bit in cycles. People will get ahead of themselves, then the market will consolidate a little bit. But these are big themes that over a long period of time will have a lot of growth in them.
Your name is often floated as one of the names to potentially come up for the top job. Is that something that you sort of think about, or that you're open to?
I think at this moment in time, my key job is to run our asset and wealth management business. And as I mentioned earlier, we have a lot of growth opportunities there. So I'm plenty busy focusing on that.
Very quickly then, in your current role, if there's a top position that Goldman's isn't in yet, what's your focus? Where would you like to be number one where you're not?
Look, I think generally speaking, as a firm, we'd like to be kind of top contender in everything we do. I would say that on the alternative side, we kind of view ourselves as a top 5 or 6 player. So we still have a good amount of room to make up to kind of be a top 3 player. So that is a big area of focus for us.
All right, Marc, thank you. That's all we have time for, but that's Marc Nachmann, Global Head of Asset and Wealth Management at Goldman Sachs. Still to come on the Asia trades, how President Trump's incoming wave of reciprocal tariffs on April 2 may be more targeted than the barrage he's been threatening.
Plus, we're back at the Milken Global Investor Symposium in Hong Kong, talking long-term allocation strategy with the Pennsylvania Municipal Retirement System CEO, Tim Reese. This is Bloomberg.
Well, Bloomberg's been told that President Trump's incoming wave of reciprocal tariffs may have a narrower approach than the broad-based barrage he's previously threatened. Bloomberg editor Michael Heath joins us now with the details. So it's being called Liberation Day, and we don't know what we're going to hear, do we?
No, there's some truth to that, Paul. I'm not sure that senior members of the administration are 100% clear yet how it's going to look, but what we are hearing at this stage is that there's not going to be sectoral tariffs. It's likely to just be reciprocal and on the main offenders with the US. This sort of dirty 15 that the Treasury Secretary mentioned last week, which, as he characterised, it's the 15% of countries that do most of the trade with the US and take most advantage of it. And this relates to both tariffs, non-tariff barriers, these sorts of things. So it does look like it's going to be a more limited hit, which I think is probably the most significant takeaway. Now, that doesn't mean later on there won't be sectoral tariffs and issues like, potentially on the auto sector, which has been talked about quite a bit. But at this stage, it doesn't look like it'll be as wide-ranging as perhaps was initially feared. And
it's sort of fairly agnostic, right? There's not been special treatment for partners that, have been favoured in the past, like Australia or Japan. It's interesting, I thought, when we spoke to Jim Chalmers, he said the impact will be seismic. We just don't know what it's going to look like. No, but it's an important point you raise, is that in Trump 1, they clearly gave out too many exemptions. That's their view, and they diluted the tariff too much. So the idea now is to give out no exemptions and then to potentially negotiate things along the way if there's problems. It obviously strengthens the US hand too when it goes to negotiate with countries that the tariffs are sort of already in place. But their attitude seems to be that you give one exemption, you're really obliged to give more, and then what's the point of it, kind of thing. And part of this is also a revenue-raising measure that's often brought into play as well. Now, how significant that is, depending on whether we get a burst of inflation or a sharp economic slowdown, we really don't know on that. But yeah, it's still not terribly clear how it's going to work, but it does seem like it's more narrow just because of the time frame. One thing that is interesting, though, is that potentially what is announced could come into place almost immediately. There won't be a delay there too. Bloomberg editor Michael Heath there. Well, Chinese Premier Li Qiang says his country is prepared for shocks that exceed expectations from Trump's reciprocal tariffs.
We may have unexpected shocks mainly from external factors. When necessary, the Chinese government will introduce new incremental policies to ensure the smooth operation of the Chinese economy.
Our Chief North Asia correspondent Stephen Angle is in Beijing at the China Development Forum taking place, and he joins us now. And Steve, you know, depending on who you ask, China is either especially vulnerable at this point given the domestic uncertainties with its economy, or potentially especially opportunistic and poised to take advantage of this.
Well, sure. Donald Trump has been very transparent about his tariff plans, and that allows China to plan for every eventuality, including an increase potentially of those tariffs of 20%, which he added to the previous tariffs that were in place throughout the Biden administration that were launched, of course, in the first Trump administration. This time, the 20% obviously is on the fentanyl issue. We'll talk about that in just a minute when we talk about Senator Steve Daines, who also was here delivering a message from Donald Trump. As you can see there, we have an exclusive interview with Steve Daines in just a minute. But Li Qiang, speaking in this room where I am now in Villa 14 of the Diaoyutai State Guest House in Western Beijing at the China Development Forum, essentially laid out that eventuality that these tariffs could be, those external shocks could far exceed what they're expecting. So they are making all kinds of preparations, no doubt. Li Qiang talked about the need for open markets. That's something the participants here obviously were welcome to hear, because market access has been a long complaint of large multinational companies wanting to do business in China. So we had Apple's Tim Cook here, Blackstone's Steve Schwarzman, Bill Winters of Standard Chartered Bank, Albert Bourla of Pfizer, among many, including Saudi Aramco's president. They all wanted to hear, yes, China is adapting to the new realities in a fragmented global economy, and what is China going to do? Now, I know, because I've been covering China for more than 30 years, you have to be in China to really feel the textiles, to feel the sheets about what is going on here. And that's what all these people gathered in this Villa 14 wanted to hear yesterday and today. I also caught up with John Quelch. He's a professor at the Duke Kunlun University. He's a longtime China participant and economist. This is what he said. There might be unintended consequences of Trump's trade actions against China as China adapts to the new reality. Here's what he had to say.
Every time tariffs are put on for Chinese manufacturers, Chinese companies double down on extra efficiency in order to eat part of the extra cost of the tariffs. So in a way, ironically, the tariffs are actually an extra motivation to China to become even more efficient and productive.
Steve, you also mentioned that US Senator Steve Daines has been in Beijing meeting with the Chinese Vice Premier. He's delivered a fairly uncompromising message, hasn't he, on what the US wants to see around the fentanyl and fentanyl precursor trade?
Well, yeah, that's right. This is the news that came out of our conversation last night. Exclusive interview with my Bloomberg colleague, Lucille Liu, and I spoke to Steve Daines. He was at the Beijing airport. We were on the phone with him just as he was about to board a flight, I presume, back to Washington, D.C., and report what he about his meeting with Li Qiang late yesterday at the Great Hall of the People, along with 7 executives from U.S. companies meeting with the premier. And this is essentially what Steve Daines' message was to Li Qiang.
It'll be difficult to have any conversation about tariffs and non-tariff barriers until the fentanyl precursor issue is resolved. President Trump's position was heard loud and clear, and the Chinese received that, they understood it, and we're hopeful that we'll see decisive actions taken to stop the flow of these precursors.
So again, U.S.-China relations now hinging essentially on the fentanyl issue, which China has said this is a U.S. demand issue. This is not China is not responsible for the drug problems in the United States. So they're at loggerheads that could be, resolved partially by a Trump-Xi summit. No timeline on that.
Our Chief North Asia correspondent Stephen Angle there in Beijing. More to come here on the Asia Trade. This is Bloomberg.
Australia's Treasurer is warning that the Trump administration's policies will have a seismic impact on the global economy. Jim Chalmers spoke to Bloomberg ahead of delivering his pre-election budget on Tuesday about the risks Australia is facing.
Now, this is a whole new world of uncertainty that we're dealing with here. The changes out of the US, for example, are not surprising, but they are seismic. We're seeing uncertainty, policy uncertainty out of the US. China is slowing. We've spoken about that on a number of occasions. We've got conflicts in the Middle East and Europe. We've got political uncertainty and division around the world. And so the budget is designed not just to respond to all of that uncertainty, but to make ourselves more resilient in the face of those external shocks. And the future made in Australia is really the most important way that we're going about that. And there's billions of dollars in new investments in green metals as part of that effort.
Unannounced ones or just the ones you've announced?
The ones that we've made clear already. They'll be budgeted for on Tuesday night. I mean, we've got a huge agenda that brings together our industrial possibilities, the energy transformation, the strengths and advantages that we have in critical minerals and in other areas. And so we intend to play that winning hand. The world is changing all around us. The world is fragmenting. Supply chains are being reconsidered and rebuilt. And we think we've got a very compelling offer to the world. And so the budget is about making the most of that opportunity, maximising our advantages in the interests of Middle Australia.
Now, on that, I mean, about a week after you hand down this budget, in fact, almost exactly, we're going to see new tariffs unveiled by the US administration on April 2nd. Are you worried that those tariffs could throw all your hard work in the budget completely off track if they are particularly, big or impressive?
Well, obviously, we're concerned about these escalating trade tensions around the world. As I said before, they are casting a shadow, not just over the budget, but over the global economy more broadly. Australia's got a very trade-exposed economy, and we are concerned about these trade tensions. Nobody wins from a trade war, least of all a country like ours. And so we're obviously engaged with the US administration, with our counterparts there, but we're also designing a budget which is all about making sure that we are beneficiaries, not victims of the way that the world is changing. Future Made in Australia is part of that. The Buy Australia plan is part of that as well. All of this is about recognising the way the world's changing and trying to make sure not that just we're not victims of that change, but that we can benefit from those change as countries around the world are looking for reliable partners like us.
Now, you've mentioned the sort of negative side from the US, but there's a potential positive side in that the new tariffs put on China might unleash a wave of economic stimulus from Beijing. I mean, obviously, there's a few unknowns at this point, but in your opinion, in the Treasury modelling, do you think that will end up being a net negative or a net positive to Australia when balancing those two factors?
Well, we've seen a number of steps taken by the administration in Beijing to try and support growth in the economy, but we're still seeing China slowing.
Australian Treasurer Jim Chalmers there speaking to Bloomberg's Ben Westcott in Canberra. Let's take a look at some of the other global headlines that we're watching. And Turkey has formally arrested Istanbul's mayor, Ekrem İmamoğlu, on corruption charges. The move to jail İmamoğlu could prevent President Erdogan's main political rival from running against him in the next elections. The arrest has already triggered mass protests in several cities. Turkey's capital market regulator has banned short selling and relaxed share buyback rules to cushion potential market turmoil. Canadian Prime Minister Marc has called an election for April 28th after requesting the dissolution of Parliament. Polls indicate that the race will be a close contest between Carney's Liberal Party and the Conservatives, led by Pierre Poilievre. Both parties have promised tax cuts and are making the case for who would be better at negotiating with President Trump over tariffs. Pope Francis has made his first public appearance since hospital treatment for double pneumonia. Sitting in a wheelchair, the 88-year-old thanked and gave blessings to well-wishers gathered outside Gemelli Hospital in Rome. Pope Francis has returned to this residence in the Vatican, where he will convalesce for the next 2 months. Let's take a look at how we're shaping up when it comes to European futures just opening up for the session at the moment. We are seeing a little bit of upside there. Euro Stoxx 50 futures and German DAX futures both up by just about a fourth of 0.5%, a little bit less than 0.5% there is what we're seeing. And of course, a little bit of a decline that we saw in that Friday session. Of course, some of the concerns over the Heathrow closure, sentiment remaining very much fragile when it comes to the uncertainty over trade tariffs and the state of the economy. We heard from the ECB President Lagarde warning about the hit to growth from US tariffs. But of course, we're looking like a slightly better day when it comes to perhaps a resumption of the rally. This is Bloomberg. Take a look at just some data we're crossing the Bloomberg when it comes to the Jibun Bank March Services PMI. This is a preliminary number. We actually see a pretty big dip from that 52 level in February, 48.5. So the composite number falling back into contractionary territory well and truly. We're seeing manufacturing also falling steeper into contraction territory from 49 to 48.3, and the services gauge also falling pretty steeply from 53.7 to 49.5. That previous composite number had been the highest since September last year, and we're snapping four consecutive months of expansion there when it comes to that fall from 52 to 48.5. This, of course, as we continue to monitor the broader trajectory for the Bank of Japan, we've seen sort of hotter core CPI coming in pretty recently, backing the really the need and the sort of the way forward for the Bank of Japan in terms of further tightening expected, but some signs of weakness certainly from these PMI numbers. This is a picture when it comes to Japanese markets at the moment. The Nikkei 225 kind of just treading water there. We're seeing a little bit more of a loss when it comes to the topics. We're watching the yen as well, seeing further weakness towards that 150 handle in the early part of the Tokyo trading session today. A lot of that tariff risk that investors are trying to navigate, the tariff agenda heading into an announcement expected on April 2nd, might be sort of at play for that. JGB futures have been trading slightly up as well. We're watching for bond purchases from the BOJ, and of course a bit of a down day when it comes to Sydney trading here as well, Paul.
Well, the Milken Institute's Global Investors Symposium is getting underway in Hong Kong, so let's get back to the event. Avril Hong is standing by with our next guest. Avril.
Indeed, Paul. I mean, it's really about these global uncertainties and how difficult it is becoming for investors to position. What about for long-term investors? Tim Reese is CEO and CIO at the Pennsylvania Municipal Retirement System, and he joins me now. Really good to see you. And you're here in Asia to talk about some of the opportunities, maybe witness some of the trends. What are you seeing and hearing in terms of structural drivers?
Yeah, thank you. So first of all, it's a pleasure to be here. Yeah, I think this is interesting. This is the first time for our public pension plan to actually travel and look inside of, outside the U.S. in terms of being on site to understand the marketplace and actually listen to some of the other managers who are managing investment projects in this part of the region of the world. I think it's going to be very illuminating for us. I plan to report my findings back to my board of trustees as it will inform some of the decisions we're going to make in terms of our long-term investment strategies.
So what exactly are you going to be reporting back about the Asian region?
Good. Yeah. Well, I think, so first of all, I think what I look at is it's not unlike for me to have traveled with a conference and sort of hear what's going on in terms of the investment community. But I think where I'm thinking about with our trustees in this day is we're going to talk about, I may share with them, okay, we're looking at private infrastructure as an example of a new asset class. Private infrastructure, we know it's global. It requires, it's a 3P partnership. And I think this is one of those opportunities I could share my findings.
What sort of private infrastructure, though? Because it's interesting how infrastructure investment has kind of evolved from roads and rails to energy transition to now more about data centers. Yeah. So how are you positioning for the future amid all this?
Well, so that's the thing. So if you look at this as a multi-step process, it's one of these things is this is the beginning where we're filtering information and we're taking that information to kind of drive our decision. So in terms of sector is what we're talking about. Is it going to be bridges, tolls? Is it going to be digital? Is it going to be other forms? Or is it going to be a multi-sector approach? That we don't know, but I think this is what the beginning is offered for us today.
What sort of criteria or lens are you then using to assess all this?
Well, I think if you think about it in terms of like criteria lens, We're obviously we're an institutional investor. Our investment horizon are 10 years. So we're long-term. So we're looking for long-term projects, managers who probably have open-ended structures that allow us to invest our capital, be able to get a quicker ramp-up period, allows us to then decide how we want to reinvest our dividends and whether we go back in a fund or we take and double down in strategy.
What about for private credit and the role that you see it in the energy transition?
Well, obviously, private credit is one of those asset classes that has grown tremendously. As we look at it today, we see it more as a U.S. domestic strategy, possibly for us, again, as an open-ended vehicle, rather than sort of a global strategy.
Okay, what about the here and now? Because the U.S. exceptionalism, that faith in it is being tested.
Yeah.
Do you see this as a speed bump or something longer term of a shift?
Well, that's the crystal ball, right? That's the thing. I think one of the things I've been saying, and I think it's true today more than ever, which is experience. I think somewhat looking at market cycles and knowing that living through other market cycles where it was unprecedented, and how did you manage your way through it? I think a steady hand, I think being calm, I think getting more definitive information. There's a swirl of activity going on. I think the executive orders aren't necessarily policy, so we don't really have a policy set that allows you to drive long-term investment growth. So from our standpoint, the performance of our plan has held up because we went to a risk-off approach in 2021 into 2022. So that's helped us sort of weather this a little better.
So are you de-risking further, diversifying further? Are you reducing allocation even more to U.S. equities?
So I think that's the answer. So yes, we're going to go, and we see by adding these two asset classes to our portfolio, we just completed an asset allocation study, 2 days of education this last week with our trustees, and we see that we can eliminate 100 basis points of risk by diversifying outside into these private markets. And then I think at the same time, we also see that we can gain a little more yield at the same time. So that's a tremendous opportunity for us.
Talk to us about where you see policies influence on price pressures, for example. I mean, the word transitory has kind of been used when it comes to inflation, but the last time it was used, we know how it ended. We're still dealing with price pressures to this day. So how is this going to shape the way you view the portfolio?
Well, I'll tell you, again, it really starts if I just, if you will, just kind of go through what is the pension plan. And I think it's really our investment policy. And in our investment policy, we know that our portfolio diversification strategy drives 90% of our return, because it's us knowing that we're going to diversify away from, let's say, a 70% U.S. equity hold into where we have now is more of a international equities. Does
that include diversifying into China, where you have little to no exposure at this point? What is it going to take for you to kind of really dip your toes into the Chinese market?
Well, I can't answer that, to be quite honest. I can't answer that because remember, we don't invest out of our office directly. We invest through managers based on our asset allocation study. As I mentioned, our asset allocation study and our managers now are in place. What we're looking to add is in the structure, private infrastructure, and private credit. It's looking at the managers in private infrastructure that we can look at what projects and where they are investing, and does it match with what we think we need long term?
Right. This is going to be a long process.
Yes.
Tim, really good to chat with you. Thanks so much for coming and sharing some of your plans with us and how you're viewing all this. Tim Reese is CEO and CIO at the Pennsylvania Municipal Retirement System. Heidi?
Bloomberg's Avril Hong there at the Milken Institute Global Investor Symposium in Hong Kong. We have much more ahead from the symposium taking place. Stay tuned for conversations with Gore Capital Partners, Wellington Management, as well as PIMCO. This is Bloomberg.
The world's largest maker of elevators, Otis, is expecting its equipment business to recover in China despite the continued slump in the country's property sector and rising trade risks. Chair and CEO Judy Marc spoke to Bloomberg at the China Development Forum in Beijing.
Property sector's been down for the last several years, a total of about 35%. We felt that in terms of the equipment segment, but what is growing is the service segment for us, and then the modernization segment, which is all about renewal and refurbishment. And so there's 9 million elevators in use here in China today. It's the single largest market for that. We want to service them, we want to improve quality of life, we want to upgrade them, and there's good demand there.
So how do you read the demand for new equipment as a proxy for the demand for new building? I mean, I know services and modernization, when an elevator hits about 15, 20 years, you kind of try to encourage modernization. But how about new equipment sales? It is down, but how much and what's the horizon?
Yeah, so there's a direct correlation. Absolutely, in terms of new construction and our new equipment market. We expect this year to be down yet again, but as I said in our last earnings call, we expect by the end of 25 for that to turn and to bottom, and then to sustain at that level. We don't think we'll see the record growth we had in 2021 in new equipment, but we do believe, and we are seeing service, modernization, renewal take over for that.
How do tariffs specifically affect your business? You're a global business, but you make locally, but how much is sourced locally? How much is exported beyond China?
Well, over the past few years, we've put a lot of resilience in our supply chain, having dual supply for almost everything that we source. We are local for local within our 17 manufacturing plants that we have today. The tariff impact to us in 2018 was about $10 million. So it's a very small impact on a very large company. We'll continue to watch it carefully. We'll continue, but we're not going to react fast. We're going to watch what happens, and we're just going to make sure we continue to support our customers.
How successful are you, though, to lock in prices of input costs, whether it's steel, copper, aluminum, rare earth magnets?
Yeah, you picked it. That is our rare earth that we use for magnets for our machines. We have a great supply chain organization. We're locked in for at least the first half of 2025, which lets us take advantage of steel when it goes down in China as well. But we take care of, we buy about $600 or $700 million of raw materials for our business. So it's manageable, and we're managing it very closely.
How concerned are you, though, that targeted industry-specific tariffs could be on the horizon? We've talked about steel and aluminum being key ones, and that's key to your product.
Yeah, certainly steel is. It's 80% of those raw materials I just talked about. We're less concerned. There's really nothing else from a targeted perspective that gives us great concern. We'll deal with it. We'll show our resilience, and we'll continue to drive our service business.
What else is front and center on your mind as you're here in China this time?
Well, it is all about policy, because as the China policy goes, the people follow. We'd like to see consumption continue, and we'd like to see that confidence back in the property market. And as we see that ability, we're just going to accelerate.
Otis Worldwide Chair and CEO Judy Marc is speaking with our Chief North Asia correspondent Stephen Angle there in Beijing. Take a look at some of the stocks that we're watching when markets open in Hong Kong and across mainland China in the next hour. We are watching BYD on the sort of expectation that they're on course to report full-year revenue above $100 billion for the first time ever, set to beat Tesla out. In fact, leapfrog is rival Tesla when it comes to that market. We're looking at record results, really helped being by that 4.27 million units that BYD delivered in 2024, really cementing its position as a top seller in the domestic market, but also, of course, watching out for those international numbers as well. 72% surge in exports to just over 417,000 vehicles last year. So watching BYD to see whether we'll see that further sort of upside reaction. Also watching Tencent and some of the other China internet and AI-related names to Tencent, really coming off the back of all of this development that we've seen across AI and large language models in China. Tencent unveiling the upgraded AI reasoning model, the Hunyuan T1. It's operationally quite similar to DeepSeek's R1 with cutting-edge logic and writing capabilities. So looking for sort of the reaction as Tencent adopts that two-pronged approach to generative AI, both in-house projects like this Hunyuan, the latest iteration, as well as open source models as well. Tencent's released released, 5 new AI models that turn text or images into 3D visuals. So watching for that, as well as Meituan in focus there as well. The inline fourth quarter print, looking at potentially some of the headwinds and the impact on margins for Meituan. Let's get some more when it comes to the new AI reasoning model from Tencent. Our China correspondent Min Lo is in Hong Kong. So we've seen sort of a flurry of releases, right? Really on the back of the momentum generated by DeepSeek. How does this compare to competitors?
Yeah, so as you said, this is the latest iteration of that Hunyuan T1 model. It operates similarly to the DeepSeek model. It's supposed to be on par with global benchmarks like OpenAI's O1 model. And a team of engineers from Tencent actually demonstrated this in a live-streamed video event where they tested a complex math problem on the T1 model and the R1 model. And they showed that the T1 model had returned results faster, Tencent claiming that the decoding speed is about twice as fast as other models with similar parameters. And this comes, as you said, after Tencent last week had unveiled 5 new AI tools that can help turn text and images into 3D visuals, which would be an important catalyst that could help gaming studios speed up the process of taking a title to market. And it comes in an increasingly crowded space because, as you said, Meituan is the latest Chinese company to join in this race, announcing that it's investing in developing its own AI model called Cat, which it would use in its own internal processes as well as in consumer services. And of course, there's Alibaba's Q1. There is Baidu, which last week also unveiled the latest upgrade to its Baidu's Ernie X1 model, which is supposed to be on par with DeepSeek, but at about half the cost. So an increasingly tight race in the AI market in China.
Min is a very busy week of earnings in China. As Haidi mentioned, we're going to hear from BYD as well. And I think it was back in 2011, Elon Musk said the idea of BYD competing with Tesla was laughable. Well, who's laughing now?
Yeah, it's a very different story now because BYD is expected to hit at least $100 billion in sales for the first time, which is a milestone that will allow it to leapfrog Tesla. It's revenue expected to surge by 27% on year, according to analyst estimates. That's on the back of strong demand domestically, about 4.2 million cars sold, but also overseas. It's ramped up its exports, surging over 70%, close to 420,000 cars sold. So investors will be looking out very closely for the sales target this year and what its aggressive pricing strategy would mean for its margins, because we have seen the company launch several tech upgrades with the launch of the latest battery model that will allow recharging within 5 minutes, adding 400 kilometers in its range. And this could be a stock that could possibly become the biggest the stock with the biggest market cap onshore for a non-state-owned companies, because last week it briefly surpassed CATL's market cap, and today traders are pricing in about 4.5% move on that stock after earnings.
Bloomberg's China correspondent Min Lo, and as Min said, it's one of the busiest earnings weeks for China. It's also one of the busiest when it comes to these events that are taking place, right? And a lot of that is being focused in China and in Hong Kong. We've already been hearing from the China Development Forum with our correspondent Stephen Engle there with a number of fascinating conversation. Of course, so much focus on what's happening in Beijing and the narrative, given the uncertainty over Trump's tariffs and the geopolitical rivalry that's really still developing there. We've also been hearing from Avril, who's at the Milken Global Investor Symposium, for sort of the market and the investor community take on all of this uncertainty. Is it sort of looking for alternatives, or is it sort of trying to leverage off some of this volatility as well, depending on which side of the fence that you're on? We're also looking ahead to the HSBC Global Investment Summit. Some fantastic guests there in that lineup, including the Yum China CEO, Joey Watt, talking about the Chinese consumption story domestically. Neil Ferguson, of course, a great voice on all things, geopolitics and sort of what's going on with the world at the moment. Also hearing from the Philippine Central Bank Governor, as well as ARC's Kathy Woods as well. No doubt AI will get a lot of bandwidth when it comes to that conversation. Boao Forum, World Economic Forum, as well as Hong Kong Sevens. Also, always a fun and chaotic time to be in Hong Kong.
Yeah, good way to round out the week there with a bit of sport as well. And that's going to be at a new venue also, the Kai Tak Terminal, moving away from, after 40 years, that home in Happy Valley. So, yeah, the end of an era there for the Hong Kong Sevens and the start of a new one. And not on that board as well, the Australian budget gets handed down Tuesday night. I'll be in Canberra on Wednesday morning for the mop-up. No, and I'll be speaking to the Finance Minister there as well. So, yeah, really, really busy week and still a busy day ahead of us. We have more ahead on the Asia Trade. This is Bloomberg.
South Korea's Constitutional Court is set to issue a ruling soon in the impeachment case against Prime Minister Han Duck-soo. It's part of the political aftermath of President Yoon Suk-yeol's abortive declaration of martial law. Our Bloomberg East Asia government editor John Herskovitz joins us now. So what are the options in terms of what could happen? We understand that this kicks off in about 7 minutes. It could actually happen quite quickly in terms of when it's handed down. And what are we looking at here?
Sure. The decision's coming fairly soon, within a matter of minutes. This is for Han Duck-soo, the Prime Minister. If Han Duck-soo is impeached, he's removed from, if the Constitutional Court upholds the impeachment, Han Duck-soo is removed from office. If they don't, he returns as the interim president, pending the decision in the Constitutional Court for the impeachment of President Yoon Suk-yeol over martial law. The key is really what the court decides on. If they just limit this to the procedural matters, like if Han acted within his authority for appointing or denying the Constitutional Court justices, then it will be difficult to glean if this has anything to do with President Yoon's impeachment. But if it touches on martial law, this may give some indication about how the court is looking at the impeachment motion for President Yoon.
So obviously a lot of leadership uncertainty in the country at the moment. How's this been affecting South Korea?
It's hit the country. It's been very difficult to find out where the country's going, what's going to happen with leadership. This is an export-driven economy. We have Trump's threats of tariffs of reciprocal tariffs coming on April 2nd. We also have in South Korea the very worrisome North Korean military threat that's going on, and how the South Korean government is going to coordinate with the U.S. in terms of its security arrangement. And also there could be another leadership vacuum. The South Korean parliament, dominated by the opposition, is looking at impeaching the current interim president, the finance minister. If he's impeached, then we'll have the education minister appointed as the interim president. If Han's impeachment holds through, it's just so much going on, and so it's a really difficult time. And it's difficult to find out what's going on with the economy, who's calling the shots, and this economy is based on exports.
All right, Bloomberg East Asia Government Editor John Herskovitz there. Still to come, we're going to speak to Gore Capital Partners and Wellington Management out of the Milken Institute Global Investors Symposium in Hong Kong. Also, Roland Berger joins us from the China Development Forum in Beijing to talk trade and tariffs. But that is it for the Asia Trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China Show is next. This is Bloomberg.